This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello and welcome to another episode of the Money and Markets podcast. I'm Danni Hewson, and this week Laura Suter's with me in the hot seat. Hi Laura.
Hi Danni. So it's been another week dominated by inflation data, with the latest US CPI coming in hotter than expected. So we'll be chatting through the market reaction to that. Plus, I'm going to dig into the latest Financial Lives survey, which shows that things are improving for households in the UK, but there is still more than 7 million struggling to pay bills.
Earnings season has started all over again. One of the companies kicking things off in the UK is the country's biggest supermarket. I'll look at what Tesco's jump in profits might signal for the weeks ahead, plus what the former Tesco boss, Jason Tarry, might bring to John Lewis, and away from retail, why defence stocks like BAE Systems and Rheinmetall received a mid-week pummelling.
And AJ Bell's head of public policy, Rachel Vahey, is going to be on hand to deliver our pensions corner this week. She's going to be answering one of your questions about the potential tax implications as the state pension increases. And our guest this week is Catherine Yueng, Investment Director at Fidelity Asian Values. And she's explaining why China is still a good investment.
But first, let's kick off with our old friend, inflation. Laura, I don't know about you, but that's all I seem to talk about at the moment is inflation.
Inflation, yeah, because now we don't talk about interest rates so much because they've been held for a while, other than every man and his dog asking me, when are they going to cut interest rates? Like I've got some sort of magical crystal ball.
Well, I think a lot of investors, certainly in the United States, kind of thought that they did have a real handle on where interest rates were going. Certainly, the Federal Reserve had signaled that there would be 3 rate cuts this year. However, now that is looking distinctly dicey. We had a pretty torrid day on markets yesterday. Almost 1% was wiped off US markets after we got the latest US inflation print because it came in hotter than had been expected. So CPI in March up 0.4%, 3.5% on an annual basis. Now, of course, when you think that the central bank in the United States target, like the central bank here in the UK, the target is 2%, it's still not quite getting there. And it's that last yard, those last few inches when you're trying to fit into a frock, those are the ones that all seem to take the longest time to shift. And we've even got the Atlanta Fed now. It's created this index where it's looking at sticky inflation. And sticky is the name that absolutely refers to what is going on in the United States at the moment. So looking at where inflation is still really hot, housing costs and energy, the price at the pump, okay, fine. But it's the service inflation, things like healthcare and haircuts, stuff that's really become ingrained because of price hikes, which have led to wage hikes, which have led to price hikes. And we sort of feel like we're on that sticky stagflation cycle now, which has really sort of grabbed hold of investors and shaken them in the last day or so. We also yesterday had meetings from the last Fed meeting, and central bankers there were saying that they are concerned about the path of inflation and that rates might have to stay higher for longer in the United States. Now, looking at the CME FedWatch tool, which gives us a real indication of what US markets are thinking when it comes to US rates, well, there had been 56% chance of a June cut before this last lot of figures. That fell to 16% after the data, and markets are now not fully pricing in a cut until November. So a lot of investors yesterday were rethinking their portfolios. Both the dollar and bond yields jumped back to levels that we last saw before Christmas. Big blue sky growth stocks all down, with the exception, interestingly, of Nvidia. But then that actually took a big kick ahead of time on Tuesday, falling 3%, clawing back some of those losses. But The US economy is different to the economy here in the UK and in Europe because it's growing about 3%. The jobs market's still incredibly vibrant. And the conversation now in the United States is, does the Fed actually need not to cut, but to consider one more rate hike? And we're recording this on Thursday morning, so it's before we get to the latest meeting of the European Central Bank and its minutes. We are expecting that it will still start talking about the potential for a rate cut in June. And of course, now everyone here in the UK is thinking, what will the next lot of GDP figures show? They come out Friday. Minuscule growth expected, but still growth. But then that flatlining that we've seen over the last couple of years, will that push the Bank of England also to consider moving before the Federal Reserve? Of course, it started to increase rates first, the first of the big central banks to do so. Could it be the first now to look at cutting? Now, just looking at markets today, futures indicates that US markets won't have a second miserable day in a row, because it looks like what happened yesterday was sort of knee-jerk reaction. But I think there's also been a bit of sort of rethinking generally. There was a huge amount of optimism at the start of the year, and now investors, they're thinking that maybe they got too excited too quickly.
And it's very interesting that off the back of that US news yesterday, we had headlines this morning coming out with Bank of England officials saying, it might be too soon to be talking about rate cuts. We're concerned about persistent inflation. So like you say, a very similar story both in the UK and the US, and a similar theme perhaps of markets being a bit too optimistic about rate cuts at the start of this year, and the reality of that perhaps setting in. But as we said at the start, alas, we do not have a crystal ball to be able to know exactly when it's going to happen. All we can go on is the comments from those experts and looking at how markets are reacting. But let's cover off some of the rest of the markets news before we move on. We had an update from Tesco this week, didn't we? And profits at that UK biggest supermarket were up.
Yeah, up by more than 300 million from a year earlier. So profits at Tesco reached 2.83 billion. And it's been really interesting to see how they've done this, because Tesco has brought down prices in order to increase market share. And it's been really fighting hard against those discounters to try and keep customers coming through the doors. And when you think about some of those big consumer giants, which have been able to maintain profits, but have really seen volumes fall. So they put prices up in order to keep things ticking over. And now things are beginning to shift, and they're having to work hard to try and grab some of that market share back. Well, Tesco really has thought about their position in the market. It's thought about its shopper. It's thought about the fact that we've seen huge, it was double digits food inflation for a lot of last year. So customers really having a difficult time, a lot of pressure to reduce prices. And Tesco have really sort of grabbed that mantle, trying to say that they're the cheapest full line grocer for well over the year. That is what the boss Ken Murphy was saying yesterday. Look, we are incredibly conscious of this. We put customers first. So it has been able to appeal to a large number of shoppers. It's also had, a very clever loyalty scheme, which it really does make the most of. That club card prices, though we know certainly the CMA is having a good look at that. But, a lot of companies really have sort of taken their eye off the ball, I think, when it comes to the future. They've been so hard considering the here and now, focusing on trying to maintain profits at a loss of volume growth. Whereas Tesco really is looking pretty fit at the moment. And it's also investing really in its business. So it is using AI to drive productivity, and it's also investing in its staff. So they've given new pay rises and also virtual perks like virtual doctor appointments. So this is a business that's really sort of firing on all cylinders. I don't think we're going to see the same sort of performance from all UK stocks, but it is good to see that the UK consumer is still able to go out and spend, and they're certainly feeling slightly more confident when it comes to their choices. But then, of course, that does raise the question when they start to get more confident, when we get those rate cuts finally, if we ever get rate cuts this year, will customers then think, actually, I don't want to trade down anymore, I want to trade up? And will they then go to high-end rivals? So Tesco has still got a battle on its hand, but it's certainly pulled a blinder at the moment.
And related to that, actually, sticking with kind of Tesco, the former Tesco boss, Jason Tarry, has taken the top job at John Lewis, which we know has had a pretty patchy performance recently.
It really has. So he worked at Tesco for more than 33 years. His most recent role, chief executive of the supermarket's UK and Ireland business. He will become chairman number 7. Now, this is a huge job. And when you look back at the job, most of the bosses at the partnership stay between 13 and 26 years. Dame Sharon White stepped down after 5 years in the role. She's the shortest serving boss in the partnership's near 100-year history. And her tenure has been nothing short of controversial. She's the first woman to take the job, and she faced a lot of controversy because she didn't have a huge amount of retail experience. And a lot of people say that it's that which has put John Lewis in the situation that it was in. Now, to be fair to Dame Sharon White, she's had a really torrid time to deal with. She's had the pandemic, and then she's had the cost of living crisis. And all of that comes at a time, of course, where the high street is always evolving. We think back just a few years ago, we were having conversations like this about Marks and Spencer, about it closing stores, needing to turn around. Now, that is a massive success story, and that is certainly something that we would expect Jason Tarry to try and emulate. It is back in profit this year, but it's had 3 years of losses. It's got a lot of lost ground to make up, and a lot of people feel that it's really lost its way. I mean, I live in the north, so for me, John Lewis hasn't ever really been part of my shopping consciousness. We only got a John Lewis in Leeds just a few years ago. But John Lewis, for you, is that somewhere that you're like, yeah, that's part of my shopping history?
I think in a way, a small amount, and I do use them more now than I used to, I think, but online shopping, not going in stores, because I never go into stores shopping anymore, really. So yeah, but I think it's more, where they've been on a high street. It's quite a London thing, I think, isn't it? All those kind of big town centres where they previously were, or the John Lewis home stores were very popular for a while. So yeah, it's definitely a stalwart of the high street, isn't it?
It really is. And the sort of never knowingly undersold mantle really did make people choose to go there because they wanted to use the expertise. But getting rid of that, Dame Sharon White talking about maybe shifting the company's focus from retail into things like property, considering changing the company's structure, bringing in outside investors. All of those things courted controversy. We obviously don't have as much information about the financial situation of John Lewis as we would if it was a publicly listed company. So I wonder exactly what is going on behind the scenes that has created this situation, which has led to her sort of mooting all of these things. And what will Jason Tarry do when he finally gets his feet under the desk?
Now, last week you and Dan were talking about record gold prices, and actually we've reached fresh highs this week. But some of those gains are seen as kind of defensive moves. But defence stocks, which had also been doing well, took a bit of a kicking earlier this week, didn't they?
Yes, they did, and recovered a little bit, but not much. So it does look like investors are in that sort of mood of, if it looks too good to be true, maybe it is too good to be true. What comes up, goes up, must come down. So we did see quite a big sell off. Things like BAE Systems, Rheinmetall, Thales, and Leonardo all getting a bit of a kicking on Tuesday. Now, these, of course, are names that have absolutely soared in terms of their share price since Russia invaded Ukraine, because governments around the world really have taken the view that they needed to rethink their defense, to stock up on equipment and commit more money to protecting their own countries. But the prospect of interest rate cuts potentially being pushed back until later in the year have really made investors look long and hard at their portfolios. And maybe they're thinking, where can I lock in profits just in case there is a market pullback? So it does feel like potentially this is something that has been a play over the last couple of days.
And finally, we should talk about the bombshell that Shell dropped earlier this week, shouldn't we?
Yeah, we absolutely should. So we had Tom Sieber on last week talking about the state of London markets. And I think it is fair to say that Shell dropped a great big bomb, because it floated the possibility that it might abandon its London listing because it is considered undervalued. When you compare it to its US peers that are listed on Wall Street, you can understand why the chief executive is taking a long list about whether or not it is where it needs to be. And of course, Shell is considered one of the stalwarts of the FTSE 100. And if it were to leave, I think it would be potentially a terminal blow. It would certainly have to really fast forward a lot of the conversations which have been taking place about how to, make London markets more relevant, to try and future-proof them going forward. Because at the moment, it's had a torrid year. IPOs really have dried up. We've seen a string of firms scrapping their listings, leaving for New York. And despite the fact that we have had regulators, ministers, and the city itself really on a charm offensive, trying to pull in other companies to float in the UK, it does just feel like the London Stock Exchange is rather unloved at the moment. So I think we know that there's been a lot of focus on trying to direct more capital into the market from retail investors and pension funds. We've obviously spoken even last week about the British ISA, whatever you think of that. However, potentially it could impact that situation. But yeah, I think that even floating the possibility that Shell might move has certainly set the cat amongst the pigeons.
And so one final tidbit of news that came out just as we started recording this was some comments from the FCA about the Woodford Fund and Link Fund Solutions, which were the administrators of that fund. We haven't had time to delve into the detail of that, but we will bring you all of the analysis of what the FCA has said in next week's podcast. But initial looks is that there's going to be some warning notices issued to Neil Woodford and to Woodford Investment Management, as well as some critical comments about how Link Fund Solutions handled that situation. We've obviously been following that long-running saga of the Woodford funds since it broke. And so we will bring much more in-depth analysis of that on next week's podcast.
So we are recording this Thursday morning, Laura, as I say, ahead of the ECB meeting and ahead of the latest GDP figures. But you've been looking at some interesting stuff which suggests that the UK economy is looking a little brighter than it was a year ago.
Yeah, so that is reflected in kind of households' experience of how they're handling bills and the rising cost of living. And so we have some new data out from the FCA, from the regulator. They do this huge batch of research called the Financial Lives survey every so often. And it's this great insight into the spending and saving and investing habits of the nation. This is a smaller version of that survey, and it's kind of a snapshot just to look at how people are coping with the cost of living crisis, how they're coping in terms of being able to pay bills, keeping up with mortgage payments, how much they've had to dip into their savings, for example. And the top line figure is that things are improving, but are still worse than pre the cost of living crisis. So the regulator found that 7.4 million people were struggling to pay their bills and credit payments in January this year. Now that's down from almost 11 million in January a year earlier, so January 2023. So a decent reduction there in terms of the number of people that are struggling to pay their bills. However, it's still higher than the 5.8 million that we saw in 2020, at the start of 2020. So before we saw that real spike in inflation and the cost of living squeeze happening. And once you kind of delve into it, there's some interesting stats in terms of nearly a quarter of people have had to use their savings or investments to cover their costs. And 11% of people say they have no disposable income each month. Of course, that paints the picture then, if you take the alternative, that lots of people are still finding that they've got disposable income and that they've got spare money each month. So it's a really interesting insight into how people are coping with the current cost of living crisis.
And still a big split between households doing okay and those still struggling. So where are the dividing lines?
Yeah, exactly. So what we've got there is, those 11% of people that have got no disposable income, and that's because their costs have risen more than their earnings have. And so they're just operating month by month. But on the other hand, that does mean that there's a very healthy majority of people that have money to spare each month, whether that's to spend on more kind of luxury, non-essential spending, or whether that's to save and invest. And if we look at that kind of saving and investing, the figures found that 44% of people have either stopped saving or investing or reduced the amount that they're doing so. But that still means that half of the population is able to maintain their savings levels or may have even increased them. And so I think what we're seeing is this kind of split fortunes, which is what we've seen all throughout the cost of living crisis. If you've been in the fortunate position where you either had surplus income anyway, or you've seen some meaty pay rises to keep up with rising prices, then actually you're not doing too badly. And particularly if you're not subject to the real negatives of rising interest rates, which is often seen in mortgages. So lots of people won't have been impacted by that, either because they own their property outright, they don't have a mortgage, or because they haven't come to remortgage yet, so they've not seen that real hike in costs. So I think that's part of the dividing line is how much you've been impacted by rising interest rates. And then part of it purely is just, has your income, your household income, managed to keep up with those rising costs, or even in some cases exceed it?
But it seems that people are still paying into their pensions, which is something that I know a lot of people were really worried about.
Yeah, there was this real concern at the start of the cost of living crisis that we'd see lots of people dipping into their pensions because they needed to take more money out of them. They needed more money to keep up with rising prices. But actually that doesn't really seem to have come through in the figures. What we've seen actually is there's only 2% of people are either cashing in their pension fully or taking out a lump sum to cover day-to-day expenses. So 2% is pretty tiny when you think about how much we were concerned that people would really have to kind of plunder those pots to pay their bills. And then also for those who are still working and paying into their pension, there was this concern that people would stop paying into their pension because they just didn't really feel like they had the spare money each month. But actually what we've seen in this data is that only 3% of people have either stopped contributions or reduced contributions in order to deal with rising living costs. And so I think the benefit of pensions is they're seen as this long-term thing. They also generally, if you pay into your pension through your salary, then they come out of your pay packet before you get your hands on the money. And so it really seems like the nation has seen that as, okay, that's stable money for the long term that I need to continue contributing to, particularly if you're then going to be benefiting from things like employer contributions, tax relief on that money. So that was definitely some reassuring figures.
Now it's time for Pensions Corner, and I'm delighted that Rachel Vahey, AJ Bell Head of Public Policy and all-round pension guru, is taking over the slot from Tom Selby. Hi, Rachel.
Hi, Danni.
So once a month, you're going to join us to answer pension questions. So if you have a pension question for Rachel, do send them over. You can email podcast@ajbell.co.uk. And this week's question, Rachel, is from Florence. And she asks, I've been taking a fixed income of £500 a month from my pension drawdown pot. I've not changed this amount, yet this month's income is a lot lower. Why is that?
Well, very briefly, Danni, this is all to do with how pensions are taxed, and that's both private and state pensions.
So what has changed then for Florence?
Well, let me go back a couple of steps. Pension income is taxed as earned income. So it's exactly the same as any income you would receive from a salary. The only difference is that you don't pay any national insurance on your pension income. The pension provider will deduct the tax from your pension income, and they will do this through PAYE, and they'll do it using a tax code that HMRC has given them. At the same time, most people also receive a state pension. That's paid out without tax, so it's paid out gross. There's no tax deducted from that at all. But when HMRC is trying to figure out what tax code applies to someone, they take the state pension into account. So when they're working out the tax code to give to the pension provider, they will say, oh, well, we're taking this amount off anyway because you're going to get a state pension. Now, the state pension has just gone up. It went up last year quite significantly, and this year it's gone up by 8.5%. So a really big increase, which is good news for people. And it's now gone up to £221.20 a week, which works out at about £11,500 a year. But at the same time, the personal allowance, which is the amount of money you can earn without paying any tax, that stayed exactly the same at £12,570. So on one side, you've got a big increase, and on the other, it stayed exactly the same. So what this really means in practice that is a bigger part of the personal allowance is now being taken up by the state pension. And this leaves less personal allowance available for your private pension income, which means you're going to be paying more tax on your private pension income. And that, unfortunately, means a lower amount that your pension provider is sending out to you.
So a sting in the tail from the fact that you're getting a bit more in the state pension. Just in terms of the future then, what can Florence expect? And is there anything that she can do to keep track of and prepare for changes?
Well, over the next few years, the personal allowance is due to keep exactly the same up to 2027-28 tax year. But looking at the figures, if the state pension increased by 4.5% this year, and then it also increased by 4.5% next year, then it would be equal to the personal allowance. And that puts any future government in a really tricky situation, and they will have to figure out what they want to do. All that Florence can do at the moment is just be aware of how her state pension is increasing and also how personal allowances work and what her private pension income is as well, and just to keep an eye on these things. What I would say at the end is that it's really quite disheartening, I think, sometimes to receive an income coming in, which is going to be lower. And I can really fully appreciate why Florence is feeling a little bit disheartened and upset at this. But overall, this is a good news story. It's the private pension is going down because the state pension has gone up by so much money, and because of the way that that's worked. So it is good news, really, in the long run.
Florence, I hope that answers your question. And yeah, I imagine you sort of prepared to have a little bit more money in your pocket from April. But there we go. Rachel, thank you so much. And as I said earlier, do email over your pension questions for Rachel. She'll be on the pod once a month to answer them in our pension corner. So do send those over by email, podcast@ajbell.co.uk.
Thanks, Danni.
And while we are talking pensions, it is peak withdrawal season from pensions. So what we see is that in April, May and June, so at the start of that new tax year period, is when we see a big spike in withdrawals from pensions. And so people get a new set of tax allowances and then take out their money for their pension. And some of that is very sensible. It will be people, taking out their year's worth of income or the bulk of their year's worth of income from their pension for them to live on for the rest of the year. And obviously that has benefits because it means that that money isn't sitting in investment markets. It means that you've got that money in your bank account. However, there is a risk that some people are just withdrawing that money because they can and because they've got this new set of tax allowances, when actually they might not need to, and it might be better placed in a pension. So it's really just a kind of word of caution. Just because you've always taken money out at that point in the year, or just because you've got some new tax allowances to use up, doesn't necessarily mean that it's the right time to take it out, or that you need to kind of maximize those things. So what we saw this time last year was this big spike in withdrawals around this time, with a record £4 billion worth of taxable payments taken from pensions during this period. So that averages out at just over £7,000 per withdrawal. And that was a big increase on the previous period, the previous year. And partly, I think that was people upping their withdrawals to keep up with the cost of living crisis, but partly it will be people just taking out more money. And I think there's just a really good moment to pause and just think about whether this is the right amount of money to be taken out and the right time to be taking out money. And so you need to think about things like, if I take that money out now, that's not going to be growing and getting investment growth. And is that going to have an impact on my pot later in life? You need to think about whether you're going to be taxed on that money and whether you could be triggering an unnecessary tax bill for that. So it's really just kind of thinking that through, particularly if you don't have a financial advisor to think through some of these things for you.
And, there is also a risk, Laura, that you could trigger a big cut to your annual allowance as well.
Yeah, exactly. So once you've taken money out of your pension, which is called kind of accessing your pension, then you could be subject to what's called the money purchase annual allowance. Pensions terminology is never like easy or sexy, is it? But anyway.
No, it's not.
So even if you just took £1 of taxable income from your pension, then that would mean that you're subject to this money purchase annual allowance, which is effectively a lower annual amount that you can pay into your pension. And so that means that normally your annual allowance of how much you can pay into your pension is £60,000. The money purchase annual allowance is now £10,000. And so that means that if you're in a situation where you're taking some money out of your pension, but you're still paying into it, perhaps you're still working, that limit could really impact you if you wanted to pay more than that in either in this year or in future years. So it's a good idea to think about whether you need to take that taxable income from your pension, and also, what you're going to be doing in future years, and whether you want to be subject to that lower annual allowance.
Okay, let's hear from this week's guest now. There's been an awful lot of focus on US-China relations this week, as US Treasury Secretary Janet Yellen has had a week-long visit, but it didn't seem to do a great deal to move the dial. But for investors, of course, there is an awful lot more to Asia than just China.
Catherine Yueng is an investment director at Fidelity Asian Values. She's based in Hong Kong and got a ringside seat to what's happening in Asian markets. So she told Danni she's pretty upbeat about what China has to offer investors, especially as more companies are looking to offer dividends and share buybacks.
Catherine, thank you so much for joining us. I want to start with China because for an awful lot of people who'll be listening to this, when they were talking about investing in Asia, China was where they were thinking about. But we've not seen the kind of recovery that a lot of people expected at the beginning of this year. So what's going on? Are you seeing any green shoots?
So when we look across the region, it's important to recognize that Asia is far from homogenous. So different economies, different markets at clearly different stages of the cycle. We have more developed markets, for example, in North Asia, like Korea, like Taiwan. Then these more emerging markets, India, ASEAN, so economies such as Indonesia, Philippines, Thailand. But what's key, whether you look at all these countries, as well as obviously China, as you highlighted, is that domestic demand story. And that's really pronounced. And we do expect it to be an area of long-term growth. Specific to China, though, just very quickly, Danni, if we look at the recovery, so both the economy as well as the stock market, especially post-COVID, so the start of 2023, really hasn't met expectations, especially when it comes to the revival of that very strong consumer that has been active for many, many years. But we are starting to see an improvement in certain data points. And I think it's important to remember that the recovery that is likely to come through in China isn't going to be the same kind of recovery we're used to. Even when you look at policy response, it's different. So I think it's this change in mindset when it comes to China that we do need to recognize.
That's fascinating because, we also have a situation now where there are incredibly frosty relations between the United States and China, and a lot of concern that that might hinder recovery and then the potential knock-on that could have to the rest of that region.
Yes, indeed. And when you look at the sort of competitiveness between the United States and China, it's been going on for many years and is likely to be in place for many, many years because China's made no secret of climbing up the value chain from a manufacturing perspective. And in fact, from a domestic point of view on the ground, there's a huge focus from a top down perspective. So from a government perspective, all the way through down to the companies in terms of innovation, in terms of research and development. I mentioned Taiwan and Korea. Some of the most highly innovative companies, as well as Japan, have historically come from those two economies. I mean, just recently, the central bank or the PBOC reportedly set up a re-lending program for science and technology companies. So basically about 500 billion RMB or in pounds or sterling terms, about 55 billion to support innovation and project upgrades. So that focus on innovation, climbing that value chain is where China expects to continue to grow and also to contribute to their GDP.
I don't want to dwell on China for too long, but I do just want to ask you about Donald Trump. There's an awful lot of talk at the moment about his potential return to the White House. Are you factoring that into your decision making now? Are people talking about that in Asia?
It's not so much about the US elections and who wins, but more so about some of the policies that can be introduced by the United States that impact the Chinese companies in terms of the fundamentals or the growth potential, or even US citizens owning Chinese companies, so sanctions and blacklists. So from an investment perspective, we do have to take into consideration macro dynamics, policy dynamics, foreign policy, but it's important to focus on the fundamentals of the underlying companies. So in general, probably more macro sensitive names like US exporters, we're tending to shy away from focusing on that more domestic consumption or demand story and companies that are beneficiaries of that.
Now, you certainly aren't putting all your eggs in one basket when it comes to sectors or countries. I don't want to focus too much on India today, but clearly it is a powerhouse. It is growing fast. So how do investors take advantage of those opportunities without getting caught out?
Yeah, I guess the risk at the moment with India is it's just so expensive. So if you look at valuations, just trading at levels where there's little margin of safety in general, not every single Indian company or sector, but definitely that enthusiasm towards the market. So India and Japan are the standouts from a regional perspective at the expense of, let's say, China, and China's trading at the other end of the spectrum when we look at valuations. Now, India, as I mentioned earlier, the resetting of expectations with China, China doesn't necessarily need to or want to grow at the same kind of GDP levels as we used to. So it's a focus on quality versus quantity, which therefore leaves India really as the GDP giant of the region. So GDP growth, it's interesting. It's likely to remain at similar levels. We're seeing a pickup in infrastructure, exactly what happened in China, decades ago. You're seeing probably after the election cycle, so the elections are coming up, or the national elections, more of a focus and potential upside in terms of capital spending from a private point of view. And the consumer has recovered post-COVID. But it's worth noting, again, the difference with the consumption pattern in China versus India, because in India, it's very much medium or mid to luxury end that's recovered, whereas the low end hasn't yet shown that kind of strength. So a benchmark or barometer of consumption in India tends to be the two-wheelers, so motorcycles. And you're seeing a pickup in SUVs as an example, but not so much the motorcycles. And so with this election campaign, the government and the parties or opposition parties really focusing on spurring on sort of the rural consumer, the lower end of that consumption pattern versus what we've already seen come through recovery-wise.
You were talking earlier about the region. I mean, it's a huge, incredibly diverse region. So when you are looking at Asia, how are you making sure that you're getting quality and that you are getting into areas which are going to be, the next success story?
It really boils down to the investment process and the understanding, essentially, of a company's DNA. So the investment process really revolves around finding a good business. So what product or service do you supply, and do you have a long tailwind for growth? Good management team. So are you trustworthy? Do you provide or do you reward, I should say, shareholders, minority shareholders? And then all importantly, price. Am I buying this stock with a margin of safety? And for us, targeting quality stocks with unrecognized or overlooked potential, we're able to do this because we have such a large research team. And the universe itself tends to be under-researched in terms of broad Asia. And when I talk about this under-research, it's primarily in the small cap part of the market. So really looking at sort of those opportunities that not many other people are looking at and seeing these smaller companies actually become bigger.
Because I know that Asia Pacific as a whole is expected to outpace global growth this year, in spite of what is going on in the Middle East. So what areas are exciting you the most? When you've got boots on the ground, what are you seeing?
Well, again, going back to that process about identifying good companies, good management, good price, it's not just one geographical location, although given where prices are, China, it looks very attractive. I guess one of the best mix of growth, quality, and valuations would be Indonesia as well. So we own a mixture of banks and consumer companies with fairly high ROEs. Reasonable valuations. So the most expensive stocks probably trading around mid-teens. But then I don't mean to keep on coming back to China, but China's seeing a number of opportunities across sectors. And we've just come out of the earnings season. And what's been a key sort of talking point or area of opportunity is the fact that Chinese companies, no matter whether they're large, small, state-owned or private, are really focusing on shareholder return. So I alluded to Japan being a very favored market over the past year, and that's because of the corporate governance change we've seen in Japan. So the Tokyo Stock Exchange really encouraging companies to increase their price to book, to pay out high dividends. The Koreans are also trying to implement a very similar program called the Value Up, encouraging Korean corporates who generally don't tend to pay out attractive dividends, or the payout ratio tends to be low across the region. But in China, it's gone quite unrecognized, probably because sentiment's been so poor. But state-owned enterprises and private companies are either engaging in a lot of buybacks or paying out very, very interesting dividends. Now, the key for this is whether it's sustainable, because now they've started this sort of this focus on total returns. But I think it almost acts as a cushion. So whilst we're not probably going to see the same kind of growth coming out of China, the market is certainly developing, and you have this other aspects from an income point of view.
A lot of investors might feel that they've been burnt when it comes to China. How do you share that story and make investors look again?
It's been tough. I mean, sentiment has really weighed on the market. You can have a company that's delivering on strategy, that's growing its market share. Many Chinese companies are interestingly creating two profit streams now. So one domestically, and then using their supply chain to grow their brand equity overseas. And it's not just through the Belt Road Initiative. I'm talking about consumer companies, robotic companies. So it's all got to do with that innovation again, and really, pivoting and being able to pivot and having that flexibility. But as I said, sentiment's been really brutal. And I think we have to recognize again about that resetting of expectations, that there seems to be a bit of a disconnect between what the government wants long-term about stable, sustainable growth versus historically the policy response, which has been big bang, very sharp, strong market rallies. And I think it's just a different paradigm that we're now in with China. And that reflects, again, this shift we're seeing with corporates in terms of shareholder return. So we still think it's a really interesting and unique opportunity in the long term.
One area where market sentiment has certainly not been dwindling at all is the sector of AI. And just looking at Asia as a whole, if you take China out of it at the moment for all those geopolitical reasons and concerns about sanctions and regulatory issues, there are parts of Asia which are absolutely flying here.
Indeed. And, we have been sort of at a disadvantage in this regard because we've been underweight the Taiwanese and Korean, just generally speaking, tech sectors. Now, if you look at the price-earnings ratio in Taiwan, it's re-rated sharply, really driven by the enthusiasm around AI. A lot of retail trading, as well as a percentage of daily turnover, has gone into this area. But when you look at the earnings and projected earnings, yes, short-term, they've stabilized, but we are mindful about the long-term track record in terms of what the companies can deliver. And in fact, when you look at even just the ASIC chip industry, so this is application-specific integrated circuit chips, the momentum and enthusiasm for these companies, it's very hard to find consistency between market expectations and companies' guidance and expected growth. So it goes back to that part of the investment process where, yes, technology is so vital, but there are some low barriers of entry in certain subsectors, and we have to be mindful in terms of that good price and margin of safety in this area.
So are there any companies that you're looking at now? Because I know that there will be some investors that perhaps feel that globally they've missed the boat when it comes to the chip sector, because some of the valuations you are talking about now are just incredible. And although we keep seeing, the likes of Nvidia performing time after time after time, the expectation is there will come a point when we hit a ceiling there. So how can investors maybe look towards Asia for a potential opportunity in this space?
Well, we do have the biggest companies in terms of Taiwan semiconductor manufacturing, Samsung when it comes to that chip manufacturing. I guess we need to also look at the demand-supply equation. And, these names started rallying during the COVID period because of a lack of supply and huge demand. Now we have the supply inventory building up. And this is where I mean about the earnings expectations. Even if you see demand rise, we have this abundance of supply. And so for us, the opportunity is more so, again, in that domestic demand Asian story, or those companies that have been really sold off because they were well loved before, let's say in China. and they can still deliver on earnings, grow their market share. And even if we do see a cyclical downturn, it's important to remember that the good companies, following that criteria in terms of good management teams, good businesses, good price, they will weather the storm and come out even stronger.
So if there's one area that you're looking at the moment that you're thinking, that's what I'm excited about, what would it be?
I still think it's this area in terms of improving shareholder returns and that focus that companies have. Because as you see this domestic demand sort of continue to build up, and I'm not just talking about the domestic consumer in Asia, I'm talking about the growth of the domestic investor, then capital markets in Asia are going to become a little bit more like the UK market. Households are going to become like UK households, where your savings and your pension is diversified into not just property, not just into a savings account, but into markets, whether it's fixed income or equities. And I think that sort of combination of the rise of the domestic investor, the rise or continued rise of the domestic consumer, of Asian companies climbing up that value chain, not just China, by the way, but across a number of sectors and a number of countries. I think that bodes well with Asia, not just in terms of EM or from an emerging markets lens, but indeed a global or even against developed markets.
Catherine, it's been brilliant to talk to you. Thank you so much for your time.
Thanks so much, Danni.
Catherine Yueng, Investment Director at Fidelity Asian Values. Now, do get in touch if there are any subjects you'd like us to take a look at, people you'd like us to get on the podcast, or of course, if you've got pensions questions for Rachel via our Pensions Corner. You can email us podcast@ajbell.co.uk.
That's all we've got for this week. Next week, Dan and Charlene are at the helm, and we're going to be focusing in on Asia a bit more next week, as Danni is going to be chatting to Ayush Abhijit from Ashoka India Equity Investment Trust. Until then, thanks for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.